So, you want to learn bookkeeping. Special Journals by Dave Marshall. Chart of accounts: the neglected red-headed stepchild. Why would I say this? In my opinion, this topic, like the red-headed stepchild, is not given the attention and respect it deserves. Many of the textbooks and courses that I've looked at gloss over the chart of accounts by giving a definition and throwing in a simple example. What is the chart of accounts? The chart of accounts is a listing of all the individual accounts in the general ledger that contains the account's name, a brief description of the account, and optional other identifiers, codes, or a coded account number assigned to aid in recording, classifying, summarizing, and reporting transactions. Your accounting system is built around this skeleton list of account names called the chart of accounts and is organized by the types of major accounts. The accounts you set up are tailored for your particular type of business. What's an account? An account is a separate record for each type of asset, liability, equity, revenue, and expense used to show the beginning balance and to record the increases and decreases using debits and credits for a period of time and the resulting ending balance at the end of the period. All the individual accounts make up or become a part of the chart of accounts. What are the major type of accounts? If you don't already know, the major types of accounts are assets, liabilities, owner's equity, revenue, expenses, and draws, dividends. How are they organized? The chart of accounts is typically organized and listed in a special order. Balance sheet accounts are listed first, followed by the income statement accounts. Note, this USA order may vary depending on your country. So you know, your chart of accounts can be as simple or complex as you need to provide the financial information you need to manage a business. The general ledger is a book containing the accounts and balances for all of a business's assets, liabilities, equity, revenue, and expense accounts. You can think of the general ledger as a file cabinet that contains a record folder for each of your accounts. Each account contains the following information: account name, account number, optional, date records the date of the posting, description is used to optionally provide additional information about the amounts posted, posting reference, post ref, to identify what special journal the amount was posted from, debit amount, credit amount, and the account balance, which is the current balance of the account after updating the debit and credit amounts posted to the account. Source documents are the original sources of information that provide documentation, proof, that a transaction has occurred, such as sales invoices, tickets, invoices from suppliers, contracts, checks written and checks received, promissory notes, and various other types of business documents. These documents provide us with the information needed to record our financial transactions in our bookkeeping records. If you recall, a transaction is any event or condition that must be recorded in the books of a business because of its effect on the financial condition of the business, such as buying and selling. A business deal or agreement. Transaction analysis: before you record any transaction in any journal, you need to analyze the transaction and first determine if it affects the financial activities of the business. If it does, you then must determine what accounts are affected and then what journal needs to be used to record the transaction. An example of a couple of business activities that many businesses track that are not initially recorded in the journals are purchase orders and sales orders. They are formally entered in the journals when the actual sale takes place or the business receives and is invoiced for the products that were ordered. Transaction analysis is really a simple task that with experience a bookkeeper performs without even thinking about it. Let's break it down into 7 simple steps. 1. Recognize that a transaction, event, has occurred and what source documents such as sales invoices, tickets, invoices from suppliers, contracts, checks written or checks received, provide documentation, proof, that a transaction has occurred. 2. Understand how the transaction, event, affects the business and whether it needs to be recorded in the formal bookkeeping records. 3. Determine what accounts are affected and whether the transaction increases or decreases the account balance. 4. Use the business's chart of accounts to determine the account numbers that represent these accounts. 5. Use the debit and credit rules to determine if the accounts are debited or credited. 6. Determine what journal should be used to record the transaction. 7. Do it record the transaction. The double entry system is the standard system used by businesses and other organizations to record financial transactions. Since all business transactions consist of an exchange of one thing for another, double entry bookkeeping using debits and credits is used to show this twofold effect. Debits and credits are the device that provide the ability to record the entries twice and are explained in more detail later in this tutorial. The double entry system also has built-in checks and balances. Due to the use of debits and credits, the double entry system is self-balancing. The total of the debit values recorded must equal the total of the credit values recorded. This system, when used along with the accrual method of accounting, is a complete accounting system and focuses on the income statement and balance sheet. This system has worldwide support as the system to use by businesses for recording their financial transactions. It got its name because each transaction is recorded in at least two places, accounts, using debits and credits. Accounting equations. Your chef, namely me, is about to divulge a secret recipe. I know you've been waiting to get the Colonel's secret recipe for Kentucky Fried Chicken. Sorry to disappoint you, but this recipe is actually a simple equation and lays the foundation on which double entry bookkeeping is built. This equation is called the accounting equation and is also referred to as the balance sheet equation. The equation may be expressed in three forms. 1. Abbreviated or simple version, property equals property rights. 2. Expanded version, assets equals liabilities plus owner's equity, capital. 3. Fully expanded version, assets equals liabilities plus beginning owner's equity, capital, plus additional owner investments plus revenues minus expenses minus draws. As mentioned earlier, the double entry is a type of accounting, bookkeeping system that requires every transaction to be recorded in at least two places, accounts, using debits and credits to represent increases and decreases. Well, this equation is what double entry is all about. We make two entries for every business transaction. These entries represent increases or decreases in property, assets, and/or property rights, liabilities, and owner's equity. In other words, the double entry system based on the accounting equation allows us to track 1. What we got and what went, property. Assets, the good stuff, and 2. From whom and to whom, property rights. Claims to the assets, good stuff. Who has a right or claim to the business's property? Claims to the property, assets, arise from two sources, creditors and owners. Debits credits. Since we will be using debits and credits to record transactions in special journals and general ledger accounts, let's revisit some old definitions. Debit: an entry in the financial books of a firm that increases an asset, draw, or an expense, or an entry that decreases a liability, owner's equity, capital, or income. Also, an entry entered on the left side column of a journal or general ledger account. Let's combine the two above definitions into one complete definition. An entry, amount, entered on the left side column of a journal or general ledger account that increases an asset, draw, or an expense, or an entry that decreases a liability, owner's equity, capital, or revenue. Credit: an entry in the financial books of a firm that increases a liability, owner's equity, capital, or revenue, or an entry that decreases an asset, draw, or an expense. Also, an entry entered on the right side column of a journal or general ledger account. Let's combine the two above definitions into one complete definition. An entry, amount, entered on the right side column of a journal or general ledger account that increases a liability, owner's equity, capital, or revenue, or an entry that decreases an asset, draw, or an expense. A journal is an accounting record that is used to record the different types of transactions using various source documents. Journals are often called or referred to as the books of original entry. The reason is that this is the first place that business transactions are formally recorded. Specialized journals are journals used to initially record special types of transactions such as sales, cash disbursements, and cash receipts in their own journal. All these journals are designed to record special types of business transactions and post the totals accumulated in these journals to the general ledger periodically, usually once a month. You can think of a journal as a financial diary. The general journal is used to record unusual or infrequent types of transactions. Type of entries normally made in the general journal are depreciation entries, correcting entries, and adjusting and closing entries. The Cash Disbursements Journal is a special journal that is used to record all cash that is paid out by a business except for payroll. The Cash Receipts Journal is a special journal that is used to record all receipts of cash. The Sales Journal is a special journal where sales of services and merchandise made on account, business's customer is allowed to charge purchases, are recorded. The Purchases Journal is a special journal that is used to record all purchases and various expenses and other charges from suppliers that a business has an open account with. Supplier allows the business to charge purchases. The Payroll Journal is a special journal that is used to record and summarize salaries and wages paid to employees and the deductions for taxes and other authorized employee withholding amounts. This introductory tutorial does not cover the payroll accounting process and records. The Sales Return and Allowances Journal is a special journal that is used to record the returns and allowances of merchandise sold on account. The Purchase Returns and Allowances Journal is a special journal that is used to record the returns and allowances of merchandise purchased on account. Why use special journals? 1. Groups and records transactions of a like nature. A familiar example is recording all cash received by a business in one place. 2. Saves time with summary and less frequent postings to the general ledger. 3. Allows a business to have different individuals responsible for different journals, thereby increasing internal controls and allocating the record-keeping workload.